REITs.
Why Baba is better than REITs?
Nice.
Welcome back to another episode of the Backholder Pod. So today, I think we'll be speaking on something that a lot of Singaporeans hold close to our hearts, which is dividend investing, or specifically REITs investing. So I think before we kickstart the topic for discussion today, just going around the table to understand if you guys have any vested interest or personally, what's your current position and how you look at REITs in your entire overall portfolio strategy. So Bunti, you want to start? Do you have any REITs, and does it constitute, and what's your overall idea of REITs around?
Yeah, you mentioned dividend investing and REITs, right? So I think these two are different. For me, I don't have any REITs positions as of now. I invested in REITs some years ago now, and I sold them off. But I still have some small position in STI ETF. To me, STI is almost like I treat it as like a dividend investing. But instead of just REITs, you have like mix of REITs and you have banks. So still considered like those most of those companies still paying dividends, right? So can treat as dividend investing. But REITs specifically, I don't have it as of now.
Okay, what about Kelvin? Do you have any REITs, and what's your perspective on REITs?
So I started with a few REITs back in, I think 2018, 2019, around there. Then when 2020 came, US stocks were booming. So I just more or less sold everything. Not more or less, I just sold everything, then just moved over to the US. So right now, REITs is not in my strategy yet. But once I reach nearer to like 50 years old, I will slowly move back.
Okay, what about Eric?
I'm pretty near 50 years old, so I have been there for quite some time. Yeah, so you all know that I have a barbell strategy, right? So I have the US side of it, and then I also have the REITs side of it. Yeah, so that's my strategy.
As a percentage of your portfolio now, how big is REITs?
REITs,
if I may ask.
It's close to, I would say, close to 50%.
Okay, understand. So personally for me, I initially when I started, I didn't have. Right now, I plausibly think that there's an opportunity, so I'm slowly adding to some of the REITs. But percentage-wise, less than 2%, I think. Around 2%. Slowly adding. So yeah, I think this provides a very good context for understanding what our individual positions. So I think to kind of round the entire topic together, maybe I'll just pass the time over to Eric to maybe share with us like what are some of the key attributes or characteristics you look at some of these REITs counter. Like before you buy, how do you conduct your DD in this case?
Okay, so my journey is like when I first started, right, I look for the highest yield. Like, dividend investing, right? We thought, wow, 7%, 8%, 9%, 10%. It's like, wow, whack those 10 years we can break even, right? So I did that when I first started, and then I realized that, although you give me a very high yield, right? Like sometimes they'll do like some placement, fundraising and things like that, and stock, what do you call that? Offering, what do you call those again? Secondary offerings. Yeah.
Right,
so
issuance. Right?
Raise capital.
Yeah,
right,
then basically yeah, rights. So basically they just keep diluting your shareholding law, and then you always have to pump more money. So that's the downside about investing in REITs, I feel, because there are some REITs always like to raise rights issue and blah blah blah, then do private placement, do a lot of those things. And then the worst thing is that when you do private placement, right, is like cheaper than the market price. If you're more on par or a little bit more expensive, then okay lah. I mean, don't mind, right? But they make it so much cheaper than like 10%, 15% discount, and then those cornerstone investor, they get it much cheaper than us, and then we are diluted lor. So the earnings we have to share with them. So basically, over the years, you find that your holdings, if you don't add to it, right, through the rights, you find that you get slowly diluted away. So I think that's where I started out. Then I realized that, I can't just look at you because that time I was noob. So as I learned, I say, okay, maybe I don't look at the yield. Maybe I look at how they grow their dividend. And then I check whether they issue a lot of rights over the years. And then I realized that there are some names, right? Like they are so-called the blue chips of the REITs. So I go more into those. They also raise rights issue lah, by the way, but not as much as those that very high yield one. Yeah, so I think the gearing also has a very big bearing. Yeah, because of all the interest rate going up, right? So I think their gearing caused them to like have to pay a lot of interest over the years. And then so their DPU, even though their rental reversions, right, has been generally positive. I think after the COVID recovering, but the DPU still not improving a lot. Yeah,
Sorry, if
yeah.
I can step in, maybe you might want to define or explain to some people what does DPU and gearing means, in case people don't really know.
Oh, gearing. I think it's their borrowings. Like
Right, leverage lah.
Yeah,
The
their
level of
leverage.
leverage, yes.
Yeah,
Okay.
on their property. So the other thing is what? DPU.
Yeah, what does DPU mean and how do
DPU
it
is
derive?
distribution per unit. So basically they all their earnings, right, that they get from their rental and then divided by all the units in the REITs. So like maybe each unit you get like 3 cents per quarter, that kind of thing. Yeah, so it's how we derive the yield lah. So every time we want to invest in some REIT, right, first thing we look at is their DPU. If it's like too low, then maybe it's not very suitable lah, because not meaningful the income. Okay, I think there is one exception I will make for this whole DPU not enough kind of thing to be considered, and the only one that I think is an exception is the Parkway Life.
It is perpetually overvalued, as in
Okay.
they don't...
Oh, this one overvalue got reason, right? I think maybe later Kelvin can share a bit more lah. We did bring up like, okay, what do you think are the strongest REIT, etc. Maybe you can discuss a bit more.
Then I'll pass the time over to Kelvin. Like, Kelvin, do you have any few factors that you personally look at when you look at dividend?
So for Eric, just now he mentioned about gearing which is at leverage lah, and the yield. That's the two criteria. Let me just show some charts to make right. Chicken need to Bunti need to enable it.
Bunti co-host.
Oh yeah, you can see. So this chart is by Keith Investment Modes lah. Here he shows most of the dividend stock. With some missing lah. Banks are missing from here lah. Not sure why. Okay. Then Oh, it doesn't change. Wait. Shit. I just changed screen. Wait. Let me change. No, wait. I see. Can ready. Okay, so this is just me copying this chart, put it. Can you see? If I change the tab.
Yeah, we can. It's on Excel, right?
Okay,
it's on Google Sheets.
So I copy it over here, then I sort it by the dividend yield lah. So this is the dividend yield. Then for me, my criteria for the DPU or dividend, DPU is one thing, dividend is yield is another thing. Dividend yield depends on the stock price. So depends on that. My criteria is that it needs to be at least 3% to 6%. So everything under 3%, I'll just remove. So Singtel will be removed. StarHill will be removed. Then all the way down, everything above 6% will be removed lah. So SIA, Capital, Suntec, everything. Lendlease also removed. Suntec. I think Suntec is really. No. Never mind. Okay. So these are the remaining ones. That are within my watch list lah. If I were to go for REITs lah. So this is the first thing. The other thing is that you can also go to SGX to filter REITs. Yeah. These are the criteria. So okay, price to earning less than 20, assuming it's a tech stock, which is not. The yield needs to be around 3 to 6%. The net profit needs to be at least 10%. This is the net profit margin. Then the price book value less than 1. Debt to equity 100 is quite high, but it's still okay. So then these are the stuff that we will come up with lah. So these are the two ways that I filter REITs lah. Yes. Then the third thing is the gearing, which Eric mentioned just now. So this is MPAT lah, Mapletree, Pan Asia. Then last year, I think 1 or 2 years ago, they merged. together, merge two REITs into one. So if you look at this gearing ratio, this aggregate leverage, another word for gearing, is 40%. For REITs, Singapore REITs, right now the maximum they can go is 45%. Any higher, they will have to lower it down. 40% means that they can't just keep buying anymore because they are very near the limit already. So what this means is that this kind of REIT that's very near this kind, they can't do as much acquisition as normally as compared to other REITs. So if you see like this the news, if I search for stuff like acquisition, right, there's no recent acquisition. Oh, wait. Acquisition. Yeah, there's none at all. Then this is Maple Logistic. Yeah, Maple Logistic. Then if I look at the 40% is still quite high. 40% is still quite high, but they have been doing a bit of acquisition. Mainly because they were like selling away old units and they are just buying in new ones. So they are actively recycling as compared to Mapletree Pen & Shield. Mapletree Pen & Shield, they don't recycle as much because their properties are more about what's that called? Shopping malls, this kind of stuff. So malls, there's only a very limited amount of malls that you can recycle. But when compared to Mapletree Logistic, this is just industrial building or logistic building. So it's much easier to recycle. So you see that, okay, the gearing ratio is high, but they are doing acquisition quite actively. Okay, then one more thing, Eric mentioned about the payout dividend growing. This is Finbox. Finbox. If you go to Finbox, you can see this payout history. You see that it's growing. This is the other criteria that I have. First is gearing. Don't need to be too high. Yield needs to be between 3 to 6. Payout needs to be optimally growing every year. 2020 was the exception, but other than that, it has been growing. This is Mapletree Pen & Shield. Mapletree Pen & Shield, the dividend payout history has been growing. This is for Mapletree Logistics, also growing. Though a bit not a straight line. Parkway Life, Eric favorite. It has been growing, but it is not growing as fast. You can see that like 2015 all the way to 2019, it's basically flat. It doesn't grow as much. So that's why it's not my favorite. You hold it, right? It becomes a fixed deposit thing. It's not really a dividend. It doesn't act like a dividend stock where it grows its stock price, doesn't grow its dividend. Yeah. In this case, Parkway Life to me is more like fixed deposit where the yield is fixed all the way throughout. Yeah. So that's my presentation.
Kevin, can I ask? Just like you mentioned, you will do a filter 3 to 6%, right?
Yeah.
I mean, the below 3%, I think many people can understand. We don't want the low dividends, but why 6%? Why don't want to go for the higher one?
So for the higher ones, that's the reason why the yield is very high. Let's say for example, Manulife, 41%. It can fight with the Bitcoin, fight with the crypto yield already. 41% means that people are, because the formula for dividend yield is stock price divided by my math failed. Dividend yield is dividend divided by stock price. The reason it's so high is because the reason it's so high is because the price is going down. Price down, dividend yield up. So the only reason why the dividend yield is so high is because price is very low. So that's the reason why. And I think there's some like mental thing, right? For Singaporeans, somehow they choose dividend stock with a range of between 3 to 6. Any higher, if it's a good one, right, they will buy and they will lower down the dividend yield. If it's too low, they will just, if the dividend yield is too low, they won't buy. So the dividend yield will just normalize back to between 3 to 6% range.
Would you want to carry on? I thought
okay.
you were saying something.
Yeah, it's okay. Pass back to Chicken.
Oh, Okay, so as in, I wanted to ask you though if you have any comments on from the sidelines, specifically because I think Eric and Kelvin gave their presentation already.
Actually, no comment. I have questions though. Just now
Yeah,
Eric
go
mentioned
ahead.
that he noticed that the rental has increased, but the DPU hasn't increased, right? Have you looked into the details? Is there any like one or two top reasons why we see the rental increase but the DPU stay the same? Is it dilution or something else?
Okay, I think there's quite a few common reasons. They say the strong Sing dollar for those who have like malls or facilities overseas. So strong Sing dollar when they translate back, then I think the currency is smaller than us, so the yield gets lowered lah. And another thing is the private placement thing, rights issue and all these things. Yeah, actually causes the DPU to decrease also. And third thing is the interest law, borrowing cost. Yeah, so I was looking up all the blue chip REITs, right? Those that are like within the 3 to 6% kind of REITs, and then I see their borrowing costs. The repayment schedule, right, is a bit worrying. If let's say the interest stays this way, right, or even goes a bit higher, next year and the following year, right, there will be close to about 40%. They need to refinance 40%. So if the interest stays this high, then the impact, right, per 100 basis point, right, will be, I think, close to like 1+% dividend, DPU. So it's quite substantial lah. So every time the Fed raises like 50 basis point, right, there's like around close to 0.7% hit to the DPU. I'm not saying for all REITs, but some REITs have calculated. So if you have a certain size, right, that will hit your bottom line. So all these factors kind of contribute, offset the, what you call that, the MPI, net property income. Yeah, so although the properties are valued higher, so they have some sort of income from that, right? But it's offset by all these higher financing expense and all these things. So they,
Yeah.
yeah.
Eric, you also mentioned blue chips a couple of times, right? In your mind, when you talk about blue chips, what are those names? Can name a few.
Blue chips, I think generally is Capital Land, Frasers, Mapletree, what else? I mean, Parkway can consider lah, because like they are by themselves, but
Yeah.
they are, I think, the only one I know, right? They are so strong, right? Even during COVID, it doesn't touch their DPU at all. No, absolutely no effect at all, zero. And they have this in escalating rental, right? Every year, based on the CPI or based on whatever, not definitely will increase one or 2 to 3% rental from the hospital. So like, I don't care what the economy does. I don't care you got sick people or not. I just increase the rental, the lower of the two lah, 1 to 3%, or is the CPI thing. Yeah. So
In fact, it's quite funny because when Kelvin was saying it acts like a fixed D, right? But when you pull out the max chart for Parkway Life, actually it just goes 45 degrees to the right. So I would like a fixed deposit that keeps increasing in value also, rather than
share this
just
thing.
retain.
Can I share this chart? I don't know whether you come
Sure.
up correct. You hold on. Okay, so can y'all see the chart?
Can
Can
see.
see this.
Table is a table, not a chart.
Oh, but what am I
Yeah,
saying? It's a table. So this now Kelvin was saying, he was showing this dividend, right, over the years. You just take a look. This is the full year dividend, right? This column, full year for Parkway Life lah. Imagine if you like bought it like 2012 lah. That's about 10 years ago, right? Then you look at the 2022, the payout is 14.38 cents compared to 10.31. In the end of 10 years, it increased roughly 40%. So if you look across, other than that year, 2016, right? Every other year it's been like just piling on. So they are quite consistent. They never, ever did a rights issue. None. So that's why it can be considered blue chip. though they are a standalone REIT, they are very, very strong financially. So basically their contract is like, how many years? Hospital, right? When they build a hospital, it's like 20, 30 years. The contract. Like basically all the more that you say Frasers, Capital and Maple Tree, how long is their contract? 1 year, 2 year? Here they are shouting like I'm the hero already. This guy got 30 to 30 years. Every year annual reversion is escalating. So that's why investors are willing to pay through their nose for this guy. So if you can see over the long term, right? If your SD is like that, I will look into it. I probably will want to take a look. But fixed D don't grow that. I mean, fixed D is very simple. Every year give you 3%, but this is 3% built on 3% compounding lah in sense. So this is I think a very different proposition compared to a fixed D. But it's not interesting lah. I mean, for most because like 3%.
My question for Eric is, why do you invest in dividend stock?
Invest for dividend.
Why do you invest in dividend stock?
So that I can get some consistent income lor.
Why do you need the income?
I don't need it lah. It's good to come in.
No, but so that already negates your needs, right? You don't need the income, but you need the income. So which is it?
It's like for me, right? I work right full time. I have a job. I don't need that income from the job.
Yeah. So then why do you invest in dividend stock, lor?
It's good to have an income. It's good to have an income stream. Like I don't know.
Yeah, okay. So the thing that I still don't understand is like people say they need it's good to have a income stream, but at the same time they don't need the income stream because they have a full-time job. So that makes it very optional kind of thing.
Why I need it? I don't really need it, but it feels good to have it. How do I put it?
But going into dividends, it acts as some sort of diversification, right? Rather than everything also go into US stock, is it not?
Yeah. Some sort of it's a different. I think it's a different geographic region, and then different source of income. One is like you have the malls and logistic or whatever. You're just renting those things like a landlord. So it's like a, how you call it, a collective landlord. So the risk is not just on you if you own one property by yourself. So if the property burns down, you're like, oh, jialat. But this one is like rights issue, like, okay, everyone the risk. So it's still not that bad lah. So it's kind of like spread out across tens of thousands of investors. So I think that, to me, I think it's a little bit helpful with the risk management part.
Okay. Yeah, I can accept the diversification part lah.
Thanks for accepting.
Yeah. But actually, when it comes to whether it pay dividends or not, sometimes I think people like they tend to, like mix up these concepts, right? Because imagine that this is a dividend investing, right? Or call it REIT investing, but instead of like just getting the dividends, if you package it like an ETF and make it accumulated ETF, right? Meaning that's all the dividends received by the funds just automatically reinvested, right? So you also will make it become like a growth investing, because it grows because dividend grow. At the same time, once you receive more dividends, you don't take the payout, but reinvested. So you will eventually like getting more dividends in the future, right? So it can become like a growth investing kind of payout. So I think all these things is something that you can do it through funds. The other way is that you can just mentally block it to say, okay, this block of dividend investing, I like it because like what Eric just said, right? I like it because I am now a landlord instead of like I'm investing in business. But at the same time, the dividend received doesn't mean I need to spend it, right? I can take the dividends and buy more REITs. So it can grow into a growth investing kind of instruments.
Yeah, essentially dividend is just a part of the company being sold and pay out in cash. So yeah, that's always why I say whether it's dividend stock or not dividend stock, it doesn't matter because in the end, it's still the exact same thing. Because when they pay out dividend, right, the stock price will adjust downwards to reflect this loss of money from the company.
Yeah, exactly. Actually, I have another questions there because we talk about REITs investing, right? There are a few types of REITs lah. So we have office REITs and then we have mall REITs, we have logistic and so on. When you guys do like REITs investing, do you have like a specific thinking of I want to get into office or mall? This kind of like that means you separate between different type of REITs. That's first question. Second question is when there are REITs that's only focus on Singapore, there's REITs that focus on Asia, and then there's also those that focus on US, right? So when you do investing, do you have a kind of like thinking I want to get into specific region or I want to avoid specific region? Is there any that kind of analysis that you want to share here? Maybe I'll have to pass it back to Eric also because he's our heavyweight here.
Okay, a lot of my investing, right, is a lot of knocks and everything lah. Because I started out investing, based on yield. Then after that, I thought about it and say, the yield is like not very sustainable because they keep asking for rights. Then after that, I shifted to blue chips, those type of very brand names one, Capital, Frasers, Maple, and then I realized sometimes they also screw with us. In what sense? In a sense, like that time there was this Hong Kong protest, right? And then the Maple Tree, I specifically invested in the VivoCity one, Maple Tree Commercial, because I like VivoCity. It's very, very strong. The rent reversion very strong, everything very strong. Then I invested in that. Then they go and merge with the Festive Walk, that one. I'm like, no, I don't want that one. But they say, oh, we approve ourselves. Then
It was a vote, right? It was voted by
it was voted,
shareholders.
but I think the majority, their cornerstone.
Yeah, don't forget that many of the Singapore
Yeah,
REITs
they're
these
like
are all owned by one.
Yeah.
I don't want to say who lah, but one entity or a few
Yes,
entities.
they support all the way one. They're like, okay, whatever you say, do it. Then they always say, oh wow, bigger size better, because but we all know that Festival Walk is the piece of. So we don't want that, but they want to, then so no choice suck thumb lah. But because once the news came out, right, most of the investors, they don't even care what's the result. They just assume that it's going through, which of course it will go through. They just dump. Once the news come out, they just straight away dump. You can see on the chart, right? Wow, it plunged like nuts, once they announced it. But I think I wasn't free at that period of time. So I came back, I saw the chart, like, oh my God. I was like, it dropped so much already, so I sucked thumb. So I held on to it until now. Recovered a little bit. But still, you can see the Festival Walk, right? If you later on, I see whether I can get the windows up again. The Festival Walk, the rent reversion is like cui. Down don't know 10+%. And then you see the VivoCity, right? Up, wow, very shook. Wow, quite a few percent. Then the Festival Walk brings down. So in the end, the overall, right, is like up 0.8%, thanks to Festival Walk. So I don't know, like another thing is another geographical region, right, which I invested quite heavily in, was the Capital Land, the China one, Capital China Retail something. So I bought quite a bit of that. Like, in fact, it was my second largest holding behind the Maple Tree Logistic. I like the prospect of it. I think China should recover very nicely, but like Chiking, I am still waiting. I'm still waiting for their eventual recovery.
Welcome to the club.
Yeah, man. So I like, wow, that REIT tree, it went down, like I bought it at 140, thereabouts, dropped to like 90+%. Wow, shag that one.
What's the thesis behind the Maple Tree Logistic? The one that you said you have quite a sizable.
Maple Tree Logistic one very funny because last time when I was a broker, right, I was sitting beside this guy. Then it dropped below $1, and then he quickly turned to me and say, "Hey Eric, look into this one. Very good one, very solid REIT." So at that time I was quite new. I was a new broker, and it's like, look at this senior guy telling me it's very good. So I like, okay lor, since you tell me good, I buy some lor. So I went to buy some of it. Then it turned out, it rebounded very strongly above $1 very quickly. So I thought, okay, then quite a solid REIT. So I held on to it. So over the years, I bought some more, accumulated until it became my biggest position. Yeah, so at one time they were very sell on about this logistic thing, right? Because of the e-commerce. So it went up super high, then the yield dropped until like 3+% or so. Then I was like, what? The yield is not even that great, but people were going crazy over the story. You know, every time there's some story, right? Then data center, then all the funny story. But after a while, they will drop back to reality. Now I think it's closer to 6%.
Yeah. But have you looked into the type of assets that they own and see like, okay, these are the assets that I want to own, and what are those that interest you?
I think the strength of Mapletree, right, is their diversification. So if you go and look at their reports, right, quarterly or annual reports, right, you see their pie chart, wow, you go nuts, yeah. The number of sectors that they have within the logistic, they're not just logistic, they have a lot of other high-tech buildings and all those things. So I think they've super diversified. Their customer base is split out into like, don't know, hundreds of tenants. I think that's their strength. They're very diversified geographically, many regions, across many different sectors. Yeah, so I think that's my takeaway for this REIT. Basically, they're not affected by any one single thing. Yeah, but COVID, they also did drop, to be honest. They did.
And until now, they haven't screwed you, huh?
They
Not like the other one.
very mild. It's a very mild screwing. Like
Okay.
a little bit right, a little bit.
Yeah.
Yeah.
But comes to the right issuance, I don't know about the others, right? Maybe can comment also. So is that the right strategy to say that every time there's a right issuance, you have to participate, right? Even though let's say you don't plan to increase your position, but you still need to participate. Take on the share first, borrow money if required. Then after that, if you after the right issuance that you want to sell, you can sell later. But if you don't participate, meaning that you actually lose out, right? Because when you don't participate, the other shareholder, they can take your slots, right? So you get like you get the 10%, they are giving you the 10% discount, you didn't take it, so someone else take it, right? So it's really the value accrued to those who took your slots now. So do you guys like participate every time? Is that the commonly right approach?
Yeah, you have to take, right? Otherwise, you'll lose out. But just treat it as dollar cost average, because you get to buy at a discounted price. From what I remember, you get to buy at a discounted price. So if you don't take, you will lose out.
Actually, that's the reason I don't like to get into REITs also, because like you need to have the cash lying around. Like let's say sometimes let's say you have quite a good position size, let's say 10-20K in one REIT, right? Suddenly they can call for all these rights, right? Could be in thousands, right? So you need to have that kind of liquidity to pump in as required. So and if let's say your REIT investing is not done on the free account, right? It's done in, let's say, like SRS or some CPF. Sometimes you just don't have that kind of liquidity in that specific account to participate. It's also quite problematic, right? I mean, from logistic point of view, like quite problematic.
Actually, if I can share why I started looking into REITs, actually it's not very the same though, because I think when Kelvin was asking about Eric, right? I think many Singaporeans like the idea of getting consistent dividend. I own all the Singapore malls. I'm gonna spend there, and then I might as well be the landlord of all the people that are gonna spend money in Singapore, whether is it commercial buildings, logistics, or malls, right? But I think to me now, I mean, as because I'm agnostic to what geography or whatnot, I do feel like some of these names, right? It starts to get interesting because of the overall valuation and the story. It feels like it's breaking down slowly over the last 2 years or so, especially because of interest rate hikes and whatnot. So I think across the board, even all your strong names, CapitaLand, Mapletree, whatever that Eric talked about, I think they're all down by at least 20-30% from their all-time highs. So there was a slight recovery in 2022, I think, and then it went back down again. So now they're just struggling or they're just trading sideways in that range. So which was why I thought that I'm not really gunning for dividend. Dividend, yes, it's interesting. It gives nice flow of income, additional income, but it's really more of like, I feel that there is an opportunity here because of the various reasons. I don't think interest rate is going to remain so high and so on and so forth. So likewise, I don't really have great insights to pick all the 30-40% yield stocks. So that's why I just look at your blue chips, and particularly so, I like CapitaLand and I like Suntec specifically. I know Suntec has their own host of problems actually. I think it has one of the highest gearing ratios as well, and one of the highest floating rate commitment in their interest rate. So when they need to renew, it's a lot more tedious when compared to many of the stronger ones. So my way of looking at REIT investing today is I'm just trying to jump onto this opportunity, if I can put it that way. Not really so I want to build a retirement portfolio of dividend stocks. That's not really the way I think about it. So just a different point of view.
Just now you mentioned CapitaLand. Is it CapitaLand or CapitaLand?
CICT.
CICT.
Yeah.
Then that Suntec REIT.
Suntec REIT. Yeah. In fact, I think to answer Bunti's question, right, I don't like touching overseas. I don't like when their portfolio very big, go into what, China, Hong Kong, that kind of thing. Funny enough, I feel like a lot of the strengths of many of these counters, right, is because of their Singapore property. And it's easier for you to understand the trends of Singaporeans and how Singapore companies work compared to like US, for example. So one example I think Kelvin was talking about was like what was it called? Manulife REIT, right, where they talk about commercial building. So in the US or in the West, right, a lot of this work from home hybrid arrangement is become the norm. But it feels like in Singapore, when I look at my friends, all the fresh grads, everybody is going back to office. Nobody asks you to work from home. So you can tell that there is inherently a different culture. And why commercial buildings in US is whacked so hard. But then when you look at Singapore, it's a different thing. Everybody's still there's some sort of reversion back, and everybody's going back to work again. So then that's why it's very hard to really understand the nuance or the intricacies of many other geography regions. So which is why I prefer at best as possible is mostly concentrated in Singapore rather than having a diversified portfolio in terms of geography. So yeah, that's just me.
So follow up for Chee Keng. You mentioned you bought them because they were sort of not undervalued.
No lah,
they are cheaper now
whacked.
because
Yeah.
of high interest rate. So do you plan to sell them when everything has recovered?
That's a good question. If I think like initially, I think the other time I was talking about it, I'm still more concerned about like the company fundamentals lah, meaning whether they're able to continue their operations and to generate that kind of dividend yield and payout ratios. So that's why I always buy like air quotes strongest lah. That's in my perspective or my opinion that they're strongest. So if there is in the future, if they start talking about wanting to expand first and do rights issue, right? I do feel like sometimes, especially like the festive walk that Eric talked about, my dad actually had a position. So then he was talking to me about it the other time. And he said that whenever there's this kind of huge acquisition or huge mergers, right, the first things first is always to sell first. Whether to buy back in or not is another thing. Meaning, because fundamentally it's not something that I bought or not something that I signed up for. So then that's why you can kind of understand the investment psychology on why people heard of the announcement that everybody just sell first, talk later. Because this is not what I signed up for. So that was the logic. But back to answer Kelvin's question, right? Whether will there be a recovery or not, or whether I'll sell, I'll take a look when they really recover lah. But I'm now kind of accumulating lah, in the phase of accumulation. Don't really have an exit plan or don't really think about selling like right now. Yeah.
Yeah. Speaking of fundamentals, right? Let me also. Wait, can you actually see?
Can see.
Okay, I think can see.
Can see.
This chart is the one that I shared in the group just now. It's showing the CICT debt profile. Because I think when speak about the fundamentals, I do think that in terms of rental, yes, there's like, one-off kind of inflations that we all experience, right? I believe all this rental already like came up quite a fair bit. Not sure whether they will continue to going up year over year. But one thing that is coming for sure is the debt that's going to mature. So say for example, this CICT, right? You look at different years, right? These are their debt profile, meaning that there are borrowings that they made in the past, and then they have to pay in 2023, 2024, 2025, and so on. So and every time they have to basically issue new debt or take on new borrowing to pay off the old borrowings. So this is how they maintain the gearing ratios. And every time when they pay, right, they actually have to sign up for a loan that's more costly compared to the past. Because what happened in the few years back is that interest rate was very low, so we can take on debt at very cheap level. But now because yield has went up so much, right? If they have to refinance, it will be refinanced at a much higher rate. I think this one also is the reason why all these REITs, right? You see that their rental has came up, but then when it comes to DPU, it doesn't. We don't see that much of the additional rental that flow to the DPU. It's because of the higher cost of debt now, and I think that's why when it comes to reinvesting, I think I'm thinking that who is suitable to buy REITs. If let's say, right, if you have a lot of cash lying around, let's say your cash is already earning, like UOB1, this kind of like high interest rate, right? So those kind of interest rate, it will come up and down depending on the interest rate environment. Same for REITs. So if you have money set aside in those deposits, and you want to hedge against the scenario where the yield will come down, right? Then I think buy a bit of REITs make more sense. Because if the interest rate drop, then your REITs will what now? But your interest that you earn from all those deposits will be lower. On the other hand, if the interest rate just stay high or even go up higher, right? Your REITs will be chui, but then when it comes to your deposit, then you are still earning a lot of interest on that end. So there's some diversification benefit between these two, just because one benefit from the higher interest rate, and then the other one is they will hit by the higher interest rate now. So I think that's the profile, or that's the kind of risk that you're taking if you load up too much risk in your portfolio. So I think this is worth to share the debt profile thing.
I think just to add on a little bit, even as we look at the debt profile, right, the maturity period, I think even between the brand names, right, there are slight differences. Like their cost of debt, some of them like AAA, AA3. Then there are those mid-tier REITs that are a bit smaller. Then I think their interest rate is slightly higher. So that one I think also plays a part. That's why I think the general consensus is if your asset under management is huge, right, the banks trust you a bit more. So they give you slightly more favorable rates. So I think still got a little bit of difference, whether you invest in Suntec or CapitaLand. There's still a little bit of difference, just to add on.
But on that note of Suntec versus CapitaLand, Suntec is definitely a more scarier, by the way. For those of you who didn't do due diligence, right, please don't just, oh, Eric say Mapletree is good, that's why I buy Mapletree, or Chiking say Suntec is good, that's why I buy Suntec. There are nuances, and I think specifically on when you just look at the stock price, if you believe that the market is relatively efficient, there is a reason why they discount some REITs more than other counters, like why Parkway Life is always so high and why Suntec now gonna be turned down by such a large extent. So please read and find out more about debt profile, maturing, floating rates, percentage, geography, diversification, blah, blah, blah. All those are kind of like the cornerstone or pillars of understanding REIT investing specifically. I don't think it's necessarily easier when compared to trying to study REITs versus growth stocks, but it's just a different game. Like you look out for different things when you look at specifically you compare Tesla, or there is no CapitaLand is better than Tesla or Tesla is better than CapitaLand. It's a different thing. There's nothing to compare. So yeah, that's just that. Kelvin, I saw you unmute.
Just now, I also want to add on to one of the benefits of investing in REITs. So other than income, fixed income, quarterly payout, and semi-annually payout, other than diversification, one thing that not many people consider is the estate tax. So let's say if Eric, or let's say if me, if I invest in REITs versus US stock, if I suddenly pass away today, my US stock will gonna tax up to 40%, while the REITs, right, there's no estate tax at all. I can totally avoid it. So this whole REITs at 50 years old thing plays in nicely. So let's say if I invest now, and if I pass away now at 50 years old, all my assets can pass down to the whatever descendants lah, versus someone who is still investing at 60 years old and investing in US stocks. They are liable to pay tax lah, assuming they don't evade the estate tax. So that's the other benefit of REITs lah.
Fun fact though, I learned about this from a friend when he talked about this estate tax thing. A bit not about REITs, but if you really want to kind of mitigate it, you can either do it under you invest under a company, you do a joint account, or you do it under a trust. I think
the joint account one is a gray area. Like from my research, right, no one knows whether it's doable or not, because joint account in the end you still have to declare one person passed away. Yeah, that is not a clear cut thing lah.
Right. Okay.
But the trust thing and the company thing is a real thing, but you have to pay annual whatever.
If your AUM is huge enough, then I guess it makes sense lah. Yeah. Eric, you wanted to comment?
Oh, there's one more thing that probably we want to take note when choosing the REIT to invest, right? Is to look at the REIT manager, right? How much of the fee they get paid lah, and how much are they paid when they have when they dispose of properties and when they acquire new properties. So you see, there are some REITs, right? They like to buy, sell, right? Then they say, wow, this is very good. And then we are recycling our capital. Then they always spin some story, right? And then you check the amount that they take as a cut. You really crazy one, like in the few hundred millions one. So it's mad lah. Then there are some asset management fee as a percentage of distribution income, right? I think you can go and Google that up. I think this is quite an old article, but maybe I share this screen. You all take a look. It's an old article, but can think about the factors here. So you see the percentage. Keppel REIT 25%. Yeah, this is their management fee, the REIT manager. So that eats into your DPU. So you want to look out for those that as a percentage is lower. And they don't anyhow acquire, dispose, just to generate that activity. Because every transaction, right, they earn a fee. And then you see whether are they paid in units or not. If they are paid in units, right, it means that their interest is aligned with yours. If the REIT price goes up, they also benefit. But if they are paid in cash, right, a lot of time they will just like, oh, do more transaction, buy, sell, so that they can benefit more. Yeah, so something to look into lah.
Anything else to round up the discussion? If not, I will. Anything? Eric, Calvin?
For me, my counter argument to buying REITs is technically I can sell options to generate income. But
different risk profile.
Yes. So,
but and it's more activity. Yeah, like you need to be active.
Correct. So even if you don't sell options, the other way is to sell us like 3-4% of your holdings. Technically, it's also a dividend payout to yourself.
The thing is, when you have dividend stocks, you already get the dividends. What else do you want? That's enough, right? Imagine you have like 1 million.
I'm talking about growth stock lah. So let's say for Apple pays, I don't know, very little, right? So you can sell off 3-4% of your Apple holdings. That is considered a dividend payout to yourself. It's exact same thing as dividend payout.
But a lot of management involved, active management involved. I need to rebalance every year. I need to come in and because you won't only hold Apple, you hold a portfolio of stocks. So everything you sell a bit to get 3% of the payout, or you're gonna sell more Apple or sell less Nvidia, or I don't know how you're gonna balance the payout yourself. So that was what I was talking about in terms of like actively following compared to if you have it in your CDP account, the money just go into your UOB1 or whatever account, and you don't need to do anything, then everything's settled. So that's probably like the peace of mind and people or why Singaporeans are more interested in many of these dividend counters lah. Yeah. Anything else? If not, I'll round up the discussion. Don't have? Okay, so I think generally for this entire idea of REITs investing, we've covered a few key factors, and I'm just going to make a very general conclusion. I think for people that are just started out in this journey, please don't just look for high dividend yield. Kelvin provided his own principle. You can look between the 3 to 6% mark, and many of them, or many a times, it's your general blue chip names that come out. So even in the blue chip names itself, they all have different profile and different ways of focus. So like Bunti suggested, it's about like sometimes about commercial, sometimes about logistics, some about malls and stuff like that. So do your own due diligence in that specific area and to understand what specific positions you want to take in or which specific sector you want to bet. And some of the key criteria that you want to look at for REIT investing, at the end of the day, it's still a form of investing. So the company's fundamentals still matter. Please look into some of the things like their gearing ratio, their leverage, their payout ratio, and more importantly, how sustainable the payout is in terms of their track record. And also last but not least, look at incentive structure, which is what Eric talked about just now as well. Whether your interest is aligned with the manager or not. So if not, if you guys have any comments or oh yeah, and maybe just a concluding roundtable discussion, maybe Eric want to provide some counters that people should look into, or maybe on your own watch list. Of course, it's not financial advice, but maybe you think that's slightly attractive at current levels to accumulate, if possible. Do you have any of you at the top of your mind?
I think those that are looking for more 稳稳假币 can look at Parkway lah. I mean, the yield isn't fantastic, but I would say it's quite stable, and it's like moving up like a tortoise. But generally, I think it's good over the long term. Yeah.
Okay, so you got your what you waited for the whole video. That's your record. Okay, of course it's not recommendation.
Oh, no,
Please.
not recommendation, please.
Yes, please do your own due diligence. If not, we'll see you in the next video. And yeah, thank you. Bye bye.